We are.
Okay, should we go ahead and get started? So should we have a quorum established, correct?
Correct, all members are here.
That's great. Okay, the next item is the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice.
Okay, next item on the agenda is public comments for items not on the agenda. Do we have any comments today?
Doesn't look like it.
Okay, so not hearing any, let's go to the next items then.
And maybe if I could
Yes,
just interrupt really quickly.
yes,
I neglected to put it on the agenda, but I think that's okay.
yes.
But I'd like to introduce our new financial commissioner, Jonathan Chang, and give him a moment to introduce himself if he would so like to.
Yeah, I'm Jonathan Chang. Been a resident of Los Altos for 5 years now. Lawyer by training, been in-house as the general counsel at Tesla. Or moving over to the general counsel position at Salvanova, winding down that role there and winding up some of my civic duties, responsibilities. One of the reasons I wanted to volunteer here, which I think has been the past 5 years incredibly good to us, neighbors, our neighborhood, and we just really adore it here. And wanted to make that community more integrated into our own lives and hoping that could help in the city in this capacity.
Well, great. Well, welcome to the most exciting commission. This is the commission. This is so congratulations on getting it.
So as I said, this is their most favorite commission.
They always come in and say this is their favorite. So they wouldn't lie to us.
Yeah.
Great, thank you and welcome.
Thank you. Thanks, Sean.
Okay, so this, let's go through the minutes of approval of the, I guess was it the
It was our last meeting in June.
last meeting in June? So can if everybody's reviewed them, can I hear hear somebody ask for approval of the minutes?
Motion to approve.
Second. Okay. We do a roll call.
All right, Commissioner Zhang,
Approved.
Commissioner Jane, Commissioner Chang,
See? Was it here?
Commissioner Fowler,
Approve.
and Chair Ottos.
I approve.
This is 4-0.
Okay. Next item on the agenda is to see the quarter reports that ended on June 30th, 2025.
Yeah, so we have here our good friends from Public Trust Advisors. John, I sent you an email
Okay.
with the link to the meeting. They've got a presentation that they want to go through. They decided to come in person. Normally if we'd have them, we'd have them on Zoom, but they were in the area, so decided to come in person. We're happy to have them here.
Sort of push John and Jesse. In person is always better.
Please. My colleagues here are just gonna hand out the
There's an update.
update. I know the agenda, it was got to 6:30, but John, I'm just bringing this because I have to plug it in.
Yes.
Because, but I do have your
Yeah, I sent you.
stuff for my battery. Stuff.
Great.
So what you have in your agenda is from June 30th. What we prepared was an update, because we've actually done a bit of work with John and Jesse over the last couple of months to really get this investment program.
Progress.
Better. Okay. And I'm allowed to go in as a panelist. Thank you, John. First of all, thanks for having us here. And Jonathan, congratulations on your role.
Thank you, sir.
I'm John Grady with Public Trust Advisors, my colleagues Sarah and Bob, and we serve as your primary relationship team. We serve the city as the investment advisor, and our role is to work with you and the city to ensure that the city's assets, your tax dollars, remain safe, but also remain well invested to help to earn as much as possible within that environment on those tax dollars to be efficient. And so what our role is here, as John mentioned, is to provide quarterly updates, usually via Zoom, but we like to be here periodically, and we thought this would be a good time, especially given the recent updates to the program. And so before I jump into the strategy that you have, if you're okay, John, Jesse, just take a couple of minutes to give you an update on Public Trust Advisors and actually now PTMA. So Public Trust Advisors, we previously were $90 billion asset management firm. We recently merged with PMA, another public funds investment advisor, approximately 45 to 50 billion in assets. That combined firm now has resulted mainly in a larger geographical footprint, but the other big news about that merger is it's really enhanced our service offerings as a firm. And some of those areas include credit research, additional portfolio management resources, investment advisory. So just wanted to share with the commission an update on our firm. It's exciting with this growth, not necessarily because we're larger, but really more so because of the services now, the enhanced services, I should say. Our focus is on public entities, so that remains our core focus, by the way. That's what we do, and that's what we focus on. So thanks for letting me share that brief update with you on what's going on here at PMA. Should be more efficient here. Apologies for that. Just going to pull these all up at the same time. Yes. So what I wanted to start with also is economic update, which you don't have in front of you, but I thought what we do as we've done in the past is just spend a moment to really just talk about what's going on in the economy, how that's impacted some interest rates recently, and then tie that into your investment strategy. Sharing is not turned on. I'll send that request, John. But while we're pulling that up, what we'll see in a moment, of course, is GDP is the first slide that I have in our economic update, and just talking about GDP for that second quarter. As you may recall, it came in at 3.8% for that final reading. And really from the first to that third reading, the largest improvement was really the consumer expenditure, consumer spending during that second quarter, which improved from less than 1% to about 1.7%, which was good news because the first quarter of 25, you may recall, we had the lowest consumer spending in several quarters. That picked up a little bit. And since we are make up a majority of our economy, thank you, John, then that really helped with that GDP figure. Again, that final at 3.8%. See if we can put that up here. Here we go. All right. The other thing I'll point out, since we have it up in front of us, is if we look at the first quarter of 25 and the second quarter, and you see the green bar and the gray bar, and the green bar, of course, is net exports, and thank you, John. And then the gray bar is domestic spending. So not a surprise in this first quarter, tariffs became the big topic of conversation. Companies started spending a ton of money to buy their plant equipment and materials to bring them onshore before those tariffs came in. That, of course, had a negative effect on how GDP is calculated. So that was a contraction. Also spending quite heavily in the first quarter here domestically. which was a positive contribution for us. As we got into the summer and then through that second quarter of 25, you can see those two components literally reversed. And really, that had everything to do with significantly reduced spending from the first quarter to the second quarter. So that actually is positive from a net exports, but it's negative from a domestic spending. And then this blue bar is what I was referring to as a slightly better consumer spending. But those are the components that really went from as you can see, a slight contraction in the first quarter to that 3.8% GDP. I think really in this, now that we're in the fourth quarter, we still will wait to see what the third quarter, but really for the second half of 25, it will likely be more dependent on us as consumers, right? Than these first two quarters, which were heavily guided by, again, tariff discussions and onshore and offshore spending by companies in particular, to really give us an idea. I know this commission, you all are very in tune with a lot of this, and I'd love to hear your thoughts from what I've heard and read from different sources, whether it's large banks, wealth managers, and so forth. It doesn't seem that anybody right now is talking recession. And we look for a 2-year period where, oh, there's going to be a recession. And, you know, we saw that from the yield curve, inverted curve. We still have that in the short space and fixed income. But it's quite interesting to see how that dynamic has really changed, especially if we think back to the spring where the thought was, oh, these tariffs are going to cause a significant reduction in economic expansion and potentially contraction. And even though we did see that in the first quarter, it really, we haven't been talking about that, and market participants for the time being seem to be very positive in this late 2025 and into 2026. We'll have to see what plays out, but that at least is good news for the time being. The other comment, and so when we're thinking, we're going to talk interest rates in a moment. When we're thinking interest rates, we're talking about the Fed in particular for overnight rates. We can't not talk about jobs and CPI. So this top chart, it's hard to see it with a small chart on the top right, but what we're showing here is initial job numbers reported. That's in the orange, in these orange bars, then the revised jobs, which are the blue bars, and then what is that net difference? And these are the gray bars. So you may recall on August 1st, when they reported the July jobs, those came in at around 75,000. They were less than what was expected, but the bigger number was actually the May and the June jobs were revised significantly down by about 250,000 just for those 2 months. So that became a big topic of discussion. And that really started to lead to more conversation, certainly from the Fed members, about maybe our labor force isn't as strong as we thought, and then potentially more leaning towards more of a rate cut than staying the course, so to speak. So the labor markets seem to be weaker than maybe what was expected. I continue to see articles about slower hiring right now, so we'll see how that plays out through this fourth quarter into the holiday season. I think a highlight though is unemployment still remains very healthy at 4.3%. By the way, the most recent jobs report and unemployment rate, as you all know, are not being reported amongst other indicators simply due to the government shutdown, which we're on day 20 now. And so that's one of those factors. But what we're seeing here is labor force maybe not as strong as the markets had thought maybe in the summer, but unemployment still seems fairly healthy. So not all bad, but I think remains to be seen. From inflation, when we look at the last several months of inflation, earlier in the year, inflation was starting to trend towards that 2% target. But in recent months, as you know, we started to see it trend a bit higher, closer to 3%. And so when we think about it, as inflation goes up, you generally think the Fed's more inclined to tighten, right? Or keep rates steady or raise them to slow down the impact of potential inflationary factors. But when the labor markets are slow, the inclination may be to cut rates to help spur. So they are literally at a crossroads when you look at their two main mandates of full employment and keeping monetary inflation tame. So it's not nearly as high as what we saw a couple of years ago, but I think these are the challenges that the Fed's going to face. That said, one of the big parts of inflation that was the heaviest burden on consumers, I believe, was the price of housing. And that was trending at 6.5, as high as 7% on an annualized basis with readings last year and the year before. And for this most recent reading, it was down into the 3.6% level. So housing costs, rents, ownership has come down. It's still increasing, but certainly not the levels that it was. So looking at those GDP, again, positive thoughts on economic growth here in the near term, but then a challenge with labor markets and potentially inflation. If we look at this most recent Fed meeting on September 17th, this is the dot plot you're likely familiar with. I showed the gray line, which was from the June meeting, and then the blue line is the most recent quarterly. They update the dot plots, of course, each quarter. And so the biggest change is really the thought was that they would start to cut rates. This chart is just showing now more recently, they're anticipating maybe one or two more rate cuts than they had thought they would need to do in the summer. Now, we all know this chart is notoriously inaccurate, but it is likely showing the trend where we are in the near term, and that is further rate cuts. And actually, you can see that here in this this is the expectations chart, pardon me, for Fed rate cuts. This is as of October 8th, but if you look at this today, it's actually very similar. The thought is in this next meeting, which is 9 days from now, that they'll likely cut that rate from 4.25%, the overnight rate, down to 4%. And then as we go down that left-hand column, potentially 4 to 5 rate cuts between now and the end of 2026. So what does that mean? That just means if they follow this trend, of course, liquidity funds, bank rates will come down with the Fed funds rate, which is natural. Hopefully they don't go much further than 3%. Hopefully they don't even go to 3%. We'll see how this plays out because we've been very fortunate in the local government fund space to have 5.5% interest rates. Those were the highest we'd seen in 20 years, actually, and had a good run with over 5% earnings on liquidity money, still over 4%. But if the trend holds, likely to see some additional rate cuts here in the near term, but still much healthier than we were certainly 5 or 6 years ago when that rate was 20 to 25 basis points as a low. I'll skip over that. That's just more of a historical chart. This is what we're seeing as of September 30th. So year over year, where the US Treasury curve was a year ago and where we were more recently as of September 30th. And really the biggest change is in this on the left-hand side, overnight rates. And that's simply driven by Fed rate cuts that we started to see last September when the Fed started to take that overnight rate from 5.5 down to now 4.25%. But as we go out along the maturity curve, not a lot of volatility year over year, but that wasn't the case during that 12-month period. So if we go from that center to the right, we can see from last fall around this time, we saw rates start to trend higher into January. And then again, as tariff talks came on board, the fear of a slowing economy as a result of higher prices, we saw rates start to trend down in the 2 to 5 year space in particular. The Fed held that overnight rate steady until more recently, where they've cut it again, as we can see that 4.25%. The other comment I would make is we were just talking about the inverted curve. So this goes back 2 years. You could take it back even further. So we're in a 2+ year period of time where treasuries, a year or longer, have actually traded below the overnight rate. And I think this is the first time in generations, certainly in decades, where we've seen that. Not normal, hence the shape of a normal curve being positive slope. So interesting to see this dynamic. And then this is where we are more recently with these shorter term rates. So if we keep this in mind and then look at your portfolio strategy, which we're going to talk about in just a moment, your longer term portfolio is still well positioned from some legacy holdings. We have worked very closely with the city and team, with John and Jesse, to actually build this out to have your liquidity portfolio. We're going to start to build out your laddered short-term portfolio. And then this is actually now positioned to allow us to start reinvesting in your active 1 to 3 year strategy. I know that's a lot of different strategies, so I'm going to show a couple of charts, but where we feel this is going to be very beneficial for the city is that you've got liquidity for your immediate needs. You're going to have this laddered portfolio. So we work closely with you all for your capital project expenditures over 1 to 2 to 3 years, a fiscal year for capital projects. And then the 1 to 2 year portfolio is designed, of course, for longer term uses as well as reserves that the city has. So I probably started to jump in this next one. Let me pause and see if the commission, John, Jesse, Anthony has any thoughts. Hopefully that was a good summary. But what we see here is likely near term short rates trending somewhat lower. But good news, at least currently, from economic outlook of not a recession being talked about constantly as it was. but certainly challenges from the labor market and hope and trying to tame that inflation. Especially with tariffs, whatever those may be. I think the big one, of course, is with China. It's still uncertain and a lot of talk that really drives, in particular, the equity markets. When we hear conversations, we see a lot of volatility over there. With that, I'll jump right in. And then when I finish, Bob's gonna provide a brief update on California Class, which is your liquidity fund that we work closely with you all as well. So through this last quarter, again, in your packet, you have June 30th, but since that period of time, we've worked closely with the city and the custodian US Bank to create a new separate custody account. The idea here is that this particular portfolio, which now has 20 million that was originally in your 1 to 3 year strategy. This was based on a lot of conversations and discussions, by the way, on cash flow needs for potential capital projects over the next couple of fiscal years. And the idea was we didn't want to invest these funds out longer when you were going to need them to pay these capital projects. So our goal here is to start to build this portfolio with a laddered structure. And as each maturity happens within the portfolio, we'll have conversations. And if the city needs those for expenses, they'll flow out of this account and into the bank so you can pay those expenditures. If they're not needed immediately, we'll look to reinvest those for you to keep that laddered structure going, knowing that there will be a maturity really in the next month or two. So that's the idea of this, what we call a short-term strategy, not daily liquidity, but a nice laddered portfolio. This also can help to protect against declining rates because we're able to lock in some of these security yields, not for very long, but you call it out to 12 months, maybe a little bit longer. If rates do go up, you also benefit because you have these maturities each month that we could reinvest at higher rates if those funds are not needed. So that's really one of the big changes here for you, is bifurcating that original portfolio into two separate ones for specific needs. So we pause there on the short term. Jesse, did I cover everything on that with you? Okay, and John. So that's our strategy. This is dynamic as it always has been. If we need to move money out in or out of the portfolio for other capital projects needs over time, we can always adjust the portfolios accordingly.
So I have a question
Yes, sir.
for John and Jesse. What is different now compared to say a year or two ago with respect to our capital project funding needs? Why do we need to put this 20 million in short-term portfolio today? When we didn't need to do this 1 year ago or 2 years ago?
Well, I'll take a stab at this. And we'll say we probably needed to do this a year or two ago, but it's something that we've been working on and really planning for the future of what we need. We also, you'll all remember when we went through our budget process, 6 months ago now, we went through all the capital projects and were able to identify there were quite a bit that the council approved for not only for this year, but for years that are coming down the road. We also know that there's a lot of infrastructure needs that we'll have over the next handful of years. And so, like I say, probably something we should have done earlier, but with the folks at it's PTMA now.
PTMA, and thank you, John.
Them coming on board, getting them up to speed, and now they've been with us for about 1.5 years, able to come up with this strategy of sort of the short, I call it the short, medium, and long-term strategies. I think John has more technical terms, but that's what I.
That's exactly what it is. It's taking the next step in your investment program.
And so part of it is that we should have done this earlier. Part of what you are saying is that our capital expenditures are going to ramp up in the near future compared to what historically they have been.
I would say ideally. I think we've had a lot of capital needs that we, for whatever reason, have not been able to address, whether it's staffing or bandwidth or time or funds, that hopefully now we have the resources in place to be able to address a lot of those projects.
How precise is the timing on the ladders in the projects? So, I mean, do we have a path then that, you know, this X project and this is the Y money that we're gonna be having in the short-term account?
I will say more or less, and we tend to estimate on the very optimistic side of, yes, we think we'll be able to do these for an easy number, 15 projects over the next, year. The reality is we probably will do 10 of them. But we want to make sure that we don't get ourselves into a situation where we start burning through a lot of our cash. And we're like, wait a minute, all of our investments or all of our other funds are tied up in investments that we can't get. And so the answer is more or less, but with sort of that more, I'll call it a conservative approach in anticipating what our expenditures
So
are.
the different maturities in the portfolio, short-term portfolio for these projects? Or is this gonna be clumps of money that come through each of the ladders?
Yeah, Mr. Chairman, so that's a great question. Our initial strategy is really just to provide what we'll consider like an equal ladder. But as we move through, as the city becomes more certain, and this is very common in our world in the public sector, that, being as accurate as possible, but you've got project managers on one side that, oh yeah, we're gonna spend, and then we recognize that. We work with a lot of portfolios. So our goal is to be, as John mentioned, more conservative. The last thing we want to do is be forced to sell a security to pay a project expenditure. This was the first step. As you start to get into these projects and have more certainty, then we can actually make investments that really kind of time the expected expenditure for those projects.
And we'll have times where we have, our annual street resurfacing project. That's a multi-million-dollar project. I can tell you right now, it's gonna happen sometime next year, right? But at some point, we will get down where we will have the project defined and we know when we're gonna bid it and award the bid. And so then we can give them that surety of, okay, we're for sure going to have this many million, and then I think we can, as a collective group, make adjustments as we need to.
Thank you.
I have one more.
Yeah, yes, sir.
So as I read this, it looks like almost all of the money is in money market funds.
Yeah.
So we have not instituted this ladder as yet, or
We just completed this transition in September. It took a little time working with US Bank to get that new custody account set up. Once we got that set up, you verifying, the account structure, verifying all the account numbers. But we're all set now. Now it's our time to go and invest these funds. One of the reasons why we certainly wanted to be here to talk about that. So this new structure is very recent, but yes, now our next step is to start laddering out these investments, which we'll be doing in a matter of days now.
and what would be the instrument for that?
Initially, I believe we'll likely use a lot of US Treasury bills, but we'll also look to use commercial paper when that's possible, because commercial paper can provide some higher yields than T-bills to keep it within that. Now, of course, commercial paper really goes out 9 months. So we'll likely see a heavy influence in US Treasuries initially, but over time, likely adding commercial paper as another investment within this short space. Yeah, great, thank you. And then lastly, looking at your traditional investment portfolio. So this is your portfolio you've had out in for a while, actively managed when we first came on. Now, what you see with regard to these portfolio characteristics on the top right, you can see the duration. We can focus on that at 0.57 years as of 9/30. That number is going to jump up to about 1.8 years. So we needed to move that 20 million out before we could start reinvesting this portfolio. The other reason why we have 2 separate custody accounts is because these are going to be managed quite differently. As you know, the latter, this one will be actively managed as what you're used to seeing with this 34 million. And so we'll rebalance this portfolio generally every month, every 6 weeks or so, to maintain that target duration of 1.8 years. Right now, the book yield on the portfolio is actually still healthy, especially with the rates having come down at 4.33, almost 4.34%. That's that second from the bottom row in the portfolio characteristics. Now that as rates have come down and we're reinvesting, you have a portion of these in money market funds that we're actually going to be reinvesting here in the near term as well. Because rates have come down over time, we'll see this book yield start to trend a little lower. That's just natural from where rates are going. But the idea of this portfolio, again, is to maintain that longer duration. And historically, these longer duration strategies have provided higher returns through interest rate cycles, but with more volatility risk. So this is why we didn't want to have funds in this portfolio that you might need for near-term liquidity. We don't want to be selling out of this just to provide liquidity. So that's where you have 21% in daily liquidity through California Class, which Bob's going to give you a briefing on in a moment. You have 29% of these assets in that 1 to 12 month ladder that will be investing for you here very shortly. And then 50% in this 1 to 3 year strategy. So next time we meet, we should see this portfolio near or not, if not at that 1.8 year duration, fully invested in the new strategy and having been actively managed. Really what you saw before, but as we believe, and as John mentioned, really a better structure for your overall program because you're identifying capital projects, you have daily liquidity, and now you have this fund that's truly for core and reserve type assets. And that's we believe, a great balance for the city, certainly going forward, especially with volatility and uncertainty out in the markets for sure. So that's a summary of where we are now, but this is will be our next step. Ladder out the short term and then start building out this portfolio to the target. And all this finally got into place here in the last few weeks. So we wanted to come here, share this update with you. We're really excited. Jesse, John, thank you for working with us and helping us to get all this into place. And I think you're in a good position, certainly, to move forward with this new program you have in place.
I agree. I think this is really an improvement on the strategy. So really happy to see this. You have to refresh my memory of the 1.8 year target and how we derived that.
Sure. So that was what we looked at. So when we're in the public space, generally you have a 5-year maturity. So most of the time investments within the public sector are anywhere from 1.8 years out to 2.5 years. When we had some discussions, that 1.8 or 2.5 years are the most common. We felt that the 1.8 year was more appropriate based on volatility, risk tolerances, and really at the time, trying to build out this program and what we've accomplished now. I would say as we manage this program the way it is currently, and as we move forward over the next fiscal year, potentially 2, if you get more comfortable with a little more duration and knowing that this is the appropriate amount for reserves, you could certainly move this duration out to that 2.5 year level. But we felt that with all the changes going on, we wanted more certainty on cash flows. That 1.8 was the better strategy to recommend. We think about that really well.
No, that does make sense with the volatility that we have in the market these days.
Cool. That's a summary. Bob, would you mind sharing?
Sure.
So as part of your investment program, oh, I'm sorry.
Before,
Of course.
Bob is gonna cover the investment performance or is?
So we don't, I know we talked about that because we were still involved in restructuring the portfolios. We don't have performance per se, but I did want to highlight that your current portfolio is providing income at a level of about 4.34%. But we can't show you a performance number until we're managing it against that benchmark. That's what we need to build this out to, that 1.8 year strategy. But from an income and from a yield perspective, you're at 4.34 at 1.8 at a half year duration. I don't even really want to compare it because we're not where we need to be. But as you saw from the other presentation, a 2 year is around 3.6%. So you've got a very short duration. You've got yields that are still above 4%. Our goal, though, when we reinvest, is to get those funds out there and have a duration of less than 2 years. You'd likely see that yield of this portfolio hopefully trending slightly above because we're using corporate notes and other structures outside of treasuries. But think of that 2 year treasury as a sort of a guide of where the yield and performance of this portfolio could be over time.
But how do we use a benchmark which is more appropriate to reflect the risk we are taking?
That's a great point. So that's with the total return. So we're showing you book yield. That total return is going to reflect the volatility, unrealized and realized gains and losses of the portfolio. And we're going to compare that. In fact, so this second bullet point, your benchmark is going to be a 1 to 3 year corporate and government index. So that index, it's an industry standard index for a 1 to 3 year strategy. And that index includes US Treasuries, AA or better corporate notes, and then government, which is Fannie Mae, Freddie Mac, those quasi-sovereign securities. So you've got a benchmark that is similar in duration and asset allocation to what your portfolio will be. And that's how we will report that and share that performance with you and compare that to the benchmark. Does that help you with Is that, okay?
So what's the timing on that?
We were hoping to have that by, start on October first to start this fourth quarter. We're into October, so we're hoping to get this invested here in the next couple. We don't want to just go out and buy everything tomorrow, but for this portfolio, start to ladder out. First of all, you've got around 4.8 million or so in money market funds from some recent maturities. So we'll be starting with that, and then we'll start to restructure some of your existing holdings to get that duration out to that 1.8 years. So our hope is to have that here in the next, call it 6 weeks or so. The other thing we wanted to mention in part of the conversation on the whole PTMA and this, the new structure of the firm is that these enhanced portfolio and credit resources are going to allow us to actually invest in a larger universe of still single, double, and AAA asset-backed corporates, mortgage-backed type securities, the same universe, but now with these additional resources, it's going to expand our reach into this space and allow for even more diversification. So we needed to communicate that with you, communicate that with the city. And now that that's in place, we can start to broaden that corporate influence.
By next quarter, we should be able to see the
Yes,
benchmarks.
Yes, absolutely. Yeah, and we'll start the total return once that duration's in place, but this next quarter we should have the benchmark on this report for you, so that you can see the yield of the benchmark versus the portfolio, and then we'll start to measure the total return for you.
Can I add something? So normally you don't start showing total return until you've had an entirely full quarter of the portfolio managed like at the strategy, which is why John is saying you're not necessarily going to see returns in January through December, but you'll more likely to see March 31st in April, May, whenever we come make that presentation.
But you'll see the market yield of that
Yes.
benchmark as of December 31st, and that will give you that guidance. But it will be a good measure, so you'll see how your portfolio is managed
Right.
against what's going on in the markets. Great. Well, thank you. If there are no other questions, and we appreciate our partnership with the city. Let me turn it over to Bob to talk a little bit about.
Thank you, John.
Thank you.
Passing out some late night reading material. Ready? No, I think we have enough.
Yep.
There you go. Everybody got one over there? Good. It's great to be back. I think it's been almost a year since I was here with John. Again, as Bob Scholl, my primary responsibility is California Class, which is a local government investment pool. You might have heard the term LGIP. But a local government investment pool is really nothing more than a money market style strategy, but built by the public sector for the public sector. So you'll see inside the folder, the two sponsors of the Joint Powers Authority local government pool that became California Class are the League of California Cities and the California Special Districts Association. John mentioned PTMA with the merger of the two firms coming together. PTMA collectively is the largest manager of local government investment pools in the country, with somewhere around $130 billion across, I think it's 29 states post the merger. So obviously a big focus of what we do. And again, PTMA is the investment manager of California Class. The city currently has approximately $14 million in California Class. The pool in total has right now about $2 billion in assets under management, with about 260 or so participants. The participant list is in that folder. You might want to take a look at that. So things have gone very well with the pool since we launched it about 3.5 years ago. The beauty of a local government investment pool and a prime fund is the net asset value is stable. You don't see movement of the share price or the net asset value outside of the dollar, but you've had a rate of return that reflects current market rates. So rates went from basically 0 to 5.5% over the course of 2.5 years. And a local government investment pool has been a great place to be to ride that wave going forward. Any questions? I'll pause just real quickly. We, in addition to the pool, with the participants you see there and the folks we talked to, we also focus on being as consultative as possible. So whether it's investment policy, cash flow analysis, you name it, we're very active in those areas. And just really enjoy a relationship with the city and working with Jesse in particular. So that's a little bit about California Class. Any questions at all?
Yeah, I have a
Yeah.
quick question. I'm not quite sure how this fits into the overall strategy. So this is $12 million, you said?
14 million.
$14 million, so that's different than the short-term strategy and long-term strategy.
Yeah, because it's ultra short term. It's for the documents, the maximum weighted average maturity in this pool is 60 days. So very, very short.
Right.
Yep.
And so help me understand this, then that overall strategy then.
Sure, yeah, it very much is a complement. So California class is literally daily liquidity. It mirrors a bank deposit. So that daily liquidity, and then you have a 1 to 12 month, and then you have this 1.8 years. So it's really, think of it, three, as John mentioned, that these three individual strategies. This California class, as Bob mentioned, benefited from that 5.5%. And it still does well, 4.25, right? It's still a good rate. What will happen when rates go down is California class and any LJEP or money market fund will feel that, as you know, immediately. Whereas your 1 to 12 month will hold on to those rates for a little bit longer, and then this longer strategy will hold on to those for, call it, approximately 2 years. So the idea is to have these three strategies. One, to make sure you have the liquidity you need. That's first and foremost, using a safe investment program overall. But they really are designed to complement each other. And then, as I mentioned earlier, as time moves on, if more money needs to go to class for liquidity, or maybe comes out of class because you can ladder a little bit more out when that makes sense, then we can be very flexible. And that's the nice thing about, the PTMA and California class partnership. I mean, we work together, we're the same firm. And then working with the cities, we have that ability to work with the city to move funds around as needed. Again, going back to that first comment I was mentioning to Jonathan, was to be as efficient as possible, but also to try to maximize those earnings with these three strategies.
So if the commission remembers, up until a couple of years ago, the city's primary, we'll call it checking accounts, we had US Bank and we had LAIF. California class is similar to LAIF. There was some desire on the part of the commission and the city a couple of years ago to not just solely rely on LAIF for investing those short terms. And so we brought on California class to be sort of a diversified option for those short-term funds.
Yeah, well, thank you for that. It makes perfect sense, yeah.
And 2 quick items. We posted today, I think, the 4.22% in California class. And the guardrails in California are pretty tight, as you know. California Code 53601, which is basically US Treasuries, agencies, commercial paper, and money market funds. So California class completely complies within the state code in terms of the holdings in the pool. So
How did we determine 14 million is the right amount?
Cash flows.
Yeah.
That really came back the same way we came up with the 20 million for the ladder, and then keeping 34 million in that 1.8 year duration target strategy, is really looking at your cash flow needs for both what we'll call immediate or very short term, then over the next 1 to 2 fiscal years for capital projects, and then reserves.
So the city's cash position right now is 14 plus 20 plus 34.
And then if you have some small balances, maybe at US Bank, that would be
Like what magnitude?
Yes. Yes.
Like US Bank, are we talking millions? Are we talking tens of millions?
We're trying to manage the balance around 3 million for the operating purposes.
You're generally earning a lot less in a bank money market fund, as you're likely aware. So the more you can move money daily out of California class, so earn over 4%. And then if you need it tomorrow, you wire it tomorrow. If you need it today, you wire it today. It's very efficient.
one last thing, the pool is AAA rated by Standard & Poor's for credit quality. So again, a very high quality, very short duration strategy for liquidity. Thank you.
Thank you for the partnership. Thanks for having us out. We love being here. And we appreciate the partnership. We'll look forward to next time giving you that update of these funds being invested and moving forward.
Thank you, John.
It's great having you here. Okay, on to the next item.
All right, well, do you want to see if there's any public comments on the investment?
Sure. Yes, that's great.
I don't know if there will be.
Yes.
For the next one, but nope. Looks like there's.
Okay. We'll head on to the next item then, and that's the public safety infrastructure funding update.
Presentation here. And while I do that, I want to give a little bit of background on this. So I believe it was in June, the commission asked about, or asked for a sort of an update on our public safety facilities and infrastructure. And so I put together this presentation. I will say, so the city council is for a number of years, public safety has been one of their top priorities. It continues to be their top priority. The council has given us lots of direction to make sure that we're adequately addressing our public safety needs, whether it's our police, our fire stations, et cetera. And so as part of that, I wanted to talk a little bit, start with a little bit of the immediate, where we're at right now, what the plans are, and then look sort of longer term from there. So as part of the most recent capital improvement and major maintenance program adoption, the city council approved spending for these specific projects. There are other funds that are going towards various aspects and maintenance, but those are generally in the operating budget. So improvements and repairs to the 2 fire stations. We have one here up on Almond Avenue, and then one down near the Loyola Corners area. Both of which are, to put it politely, old and in need of some major improvements and maintenance. The funds that have been identified are for the most immediate needs, in particular, the roof at Almond Station, which luckily is not fully collapsed, but needs to be replaced. The police substation, that is the city's property down at 999 Fremont in Loyola Corners. Those are funds to convert that into an area where officers can check in to write reports. They can use the restroom, take break, whatever they need down there, so that they aren't having to travel all the way up here to the police station to do those things. The EOC, this has been a multi-year project. Those are the funds that are remaining for primarily the generator, which will be coming soon and should be wrapped up. And with that, our emergency operations center should be fully up and ready to go. And then $300,000 for helping to design options. It's called police building design, but it's more of what are the various options and costs associated with those options, whether it's renovating it, it's expanding it, it's tearing down and building new, just so we have some idea of what the various costs would be for that project. So those are the projects for, excuse me, for the current fiscal year. And those are in various stages. As I say, the EOC is very nearly done. The police station building design, we're almost have somebody on board to help us do that, and hopefully should have that in the next few months. And then some of the others are in various stages along the way. But with that said, and as yes, go ahead.
So those are these funds that have been actually allocated down so that this is money spent?
This is not money spent yet.
Okay.
But this is money that has been approved, appropriated, and hopefully will be spent, or at least starting to be spent this current fiscal year. But as I said, we do have a number of additional needs, and some of them will be very extensive. Once we come back, once we have sort of an idea of options for the police station, that will be a very large expense. I mentioned the 2 fire stations are very old. we will have a lot of needs, in the future. And so one of the things that we've been doing is trying to plan for, sort of the longer term. How do we fund those options? Identifying what are the priorities of the community? What are the priorities of our public safety teams, et cetera. This past year, we did a community survey, asking the community, what are the priorities, what are your needs? And I'll go into a little bit of that. But I did want to start with, sort of the higher level. As John mentioned, has been some uncertainty at the federal level, as well as at the state level, and what are the impacts to the city with that. Now, we in Los Altos are not reliant on federal funds. In fact, we typically don't receive federal funds unless it's a grant for a specific project. So while other agencies are seeing budget cuts and reduced revenues, we haven't seen that yet. And I will say that one of the things that we, as well as some of our neighbors and other cities in California are thinking about is, if there's a disaster, can we rely on funds from FEMA? As we've seen, there are a lot of agencies that are struggling to get those funds. And so can we rely on that if there's an emergency around? As well, we aren't heavily reliant on funds from the state. But there is always the question of, well, will the state realize, hey, we've got a budget shortfall, so we're gonna take these funds that typically would have gotten to cities like Los Altos, and we're gonna use them in Sacramento. As of yet, that hasn't happened, but we don't know if it will or not. And so, like I say, as part of our long-term planning, on the part of the staff, the council, and the commission, is thinking about these things and how can we as Los Altos make sure that we're sort of self-sufficient in times of an emergency, in times of need, and make sure that we are addressing our public safety infrastructure needs. As I mentioned, we did survey the community. These are some of their highlights. Unsurprisingly, making sure that our 911 emergency response is taken care of and protected. Not a surprise, but when people have an emergency, they want to know that there will be somebody that they can call and get the help that they need. A big priority is the centered around wildfire safety. This, I think, largely stemmed a lot from the fires down in Southern California. While Los Altos itself, the vast majority of Los Altos is not in a designated wildfire area. We are very close to one. As we saw, I can't remember how many years ago, when the fires were starting to move over the mountain. It could very well happen that there is a fire up in the hills, and so residents want to make sure that we are able to address that and keep the community safe. And then, as I mentioned, the priorities that sort of shook out of that 911 operations wildfire, making sure that the streets and roads are taken care of. The roads are fixed, potholes are filled. And a lot of that will go into the safety response of, our police and fire. And then making sure that our fire facilities are up to date and modernized, and they have the equipment that they. And so what?
Hey, John?
Yeah.
Sorry, I'm gonna go back a couple of slides. One more. Can you talk a little bit about, oh, sorry, one more. The last point there, as of 2025 budget cycle, can you talk a little bit about that?
Yeah, so the city has over the years has built up reserves. We have a policy of having at least 20% operating reserve. We set those funds aside every year. But on top of that, we've used savings over the years. And I forget the exact number that we're at, but we're about 40 to 45% of an operating reserve. And so having those funds that we've been setting aside to help address some of these needs, and making sure that if there is a disaster, if there is some sort of immediate need, that we have the funds available to handle that. But as it says, it's sort of that juggling act of, do we start using those funds for, whether it's police station, fire station, whatnot, with the uncertainty of, are there going to be future cuts from Sacramento or whatnot, that we may need to dip into those funds as well. Does that make sense? I'm not explaining it well, I don't think.
I can say it simpler, I think,
Okay.
and then you can correct me if I make a fool of myself. So we went from 20% operating reserves to 40% this year, as you said, approximately 40%.
Right.
Right.
Yes, so we have our
But-
designated operating reserve, which is 20%, and then we have funds on top of that that are not designated for anything right now.
Yeah.
They're not assigned, they're not budgeted, they're sitting there in one of their accounts, earning, that could be used, whether it's to address a police station, a fire station, whatnot. But the uncertainty of what the bullet point is trying to say is, the uncertainty is, if we use that there and then Sacramento takes, we may not have the funds. Right, we may have to then start to bring it into our operating reserve, which is not something that anybody wants.
But it's, yeah, so, but it's isn't it
It's
undesignated general account?
Yeah,
General fund,
general fund dollars,
Yes.
they're unassigned.
unassigned,
Yeah.
so.
That's the $50 million.
Yeah, it's about. The unassigned balance was just about.
So the way to look at it is, we have our target of 20%. We have another approximately 20% of unassigned fund balances available to us, but of course, we start spending it, it's not available. So that's.
But it sounds like we
It's
might
about-
need it for
Yeah.
major projects, right? The
Right.
police station, fire station.
And really, it's a good problem to have,
Yeah.
if you essentially have double here.
And that's a conversation, and that's sort of the point of this, is that's the conversation that we will have to have as whether it's staff, community, the commission, council, is the need for us to use those funds on, say, a police station. And if so, yes, we want to do that, recognizing the trade-off that we are spending dollars that could be.
So we haven't dipped into the first 20% reserve. We are
We're
starting
topping
to,
it up.
we are starting to touch into the next.
So each year, our budget has been increasing to some little extent, and we keep topping up to the 20%. Sorry, I should have taken over, but this is helps me understand. Yes,
In theory, yes, we would be, the 20% would stay whole. And as Councilmember Meadows is saying, each year we'll top it up because our expenditures go up. And so we'll keep bumping up to make sure that we're at our 20%. And then in an ideal year, in theory, that unassigned will start to come down. Now, what has happened is through fantastic budgeting by Jesse and her team, as well as the council, right, our revenues have exceeded or continue to exceed expenditures, and so that unassigned fund balance keeps growing, right? We'll take some of the savings and it'll go to various reserve funds or whatnot, but then in reality, the unassigned balance keeps going up. But as Councilmember Meadows says, it is a very good problem to have. I think I said during the last discussion on the budget, if we didn't have that problem, well, we'd be having a very different discussion, right? So.
Okay, thank you.
So as I mentioned, we are having conversations and discussions and planning. One of the things that we're gonna do, for, in the near future is go out to the community, talk with them. As I mentioned, we did the survey. Now we want to go and get sort of the more, that was quantitative. We want to get more of the qualitative, you know, what are your priorities? What are your thoughts? We have created a website or a page on our city website where folks can go. They can take a short questionnaire and list out some of their priorities, as well as sign up to be notified or ask questions if they want us to come and present to their neighborhood group, to whatnot. We're happy to do that, just to get as much feedback and conversation. Make sure everybody is aware the good position that we're in, but making sure that as a city as a whole, we are planning. And as I said, that'll be happening over the next several months. Already started scheduling deal.
How was the survey done?
What's that?
How was the survey done?
So we hired Godby Research, which is their all they do is scientific surveys where they survey the community. They see that there's 400 and some responses, all statistically valid. They did phone, text, email, all the various ways of communication.
And how are you scheduling these sessions? How are you deciding where to present it all?
Whoever wants to talk to me, I will come and talk to them. If the scheduling works.
Yeah, no, I'm just trying to ascertain that it's representative, not a squeaky wheel kind of thing, that somebody who's louder, they get their wishes versus what the city as a whole.
And that's certainly something that we really want to make sure that we are talking to as many people as we can. So if you have neighbors or people that you want me to talk to, let me know.
So
But yeah.
going back to the survey, so you said, you know, texts, phone calls, were these also mailed out like in paper form?
Not paper forms, so this is entirely electronic. And this was not a self-selection, other than, you know, you could choose whether to participate or not. This was
That's good.
they went out and they contacted people to make sure that they were getting a good representation of the city.
The session sounds self-selected,
Yeah.
at least the survey wasn't.
So, just to leverage off the idea, I mean, one of the things maybe the city should be is thinking about communicating how well we are for doing financially, how well run the financials are for the community. So, I mean, I think we've been doing it for several years. I've been around, I'm sure before, that it's been going really well. But it would be great for maybe the community to know more about that too. As we, so I don't know if that's something as a commission we would want to talk about in terms of how to get that message out too. Along with the stuff that you're talking about, community outreach.
We are always happy to tell everybody the great job that we're doing.
Shouldn't be shy. But maybe we should add that to an agenda item for the commission to talk about how we can support that, or how we can let the community know more about our finances.
I'll add that other cities, when I see them at various farms, were very envious of our surplus versus most of them had deficits.
Now, add a slight tangential anecdote. not exactly about, the surplus, but about the quality of the services that the city is offering. So today is Diwali, which is like the Indian big Christmas equivalent, and this is culmination of 3 weeks or so of festive period. And there was a event here in community center about 3 weeks ago, Indian celebration. It's like a dance and all. Lots of people came and all that. And I heard so many people remark that this is a wonderful community center. This is the first time it was held in this community center. Previously, it was in like a school, lots of etc. And it made me feel very good how many people appreciated the community center and how good it is. So I think we just need to make it more widely known that the services the cities provide are very good. People appreciate it.
Yeah, we can certainly have a future agenda item where we can, staff can present some ideas and some of the things that we're already doing and how we can enhance those.
I think you just signed up on TikTok at the same man.
They want the old guy on the TikTok.
Bad idea. Do you want to see a public comment? If there's no other questions.
Yeah.
Any public comment?
So I do have a question. So this agenda item was triggered by public comment in a previous meeting, right? In June?
I don't know if it was public comment or if it was the commission that you mentioned.
Public comment that we had said, yeah.
And my recollection is there was specific thing, whether it was a roof of the fire station or some. Does anybody recall what specific item it was and whether we have covered that in this conversation?
I don't recall the specific item, but if it was the roof, I mean, that has been budgeted for.
That's my vague recollection. I'm
Yeah.
hoping somebody else recalls it better than I do.
Yeah, it was me.
And was the roof?
Among other things, the police station gets flooded every single time. Your people should go over and look at the police station.
And I mean, the discussion here, do you have any comments?
I think they're trying their best.
The police?
No, the police are doing good. I mean, I think the public works in this town need a lot of help. And I think it's been many years of, we'll do it next year, we'll do it next year, we'll do it next year. And I just don't want to see us have the same thing as happened in other communities where the whole place burns down for some lack of proper preparation.
Next item on the agenda then, the work plan.
Yeah, so I included our current year's work plan as well as a draft for next year's work plan. So the commission will meet with the city council in late January, early February. I don't have a specific date yet. And so since we only have a couple of meetings before then, I wanted to give the commission a chance to look at the current year work plan, which I will try to bring up right now. As well as discuss whether there's anything to add to next year's work plan. Whatnot, and you'll see that the commission has done and completed most of the items on the work plan. Of course, a lot of what the commission's work plan is sort of scheduled, and it's, specific times things happen. And so the commission has done a great job making sure that we get through that. I think the last thing that is scheduled to be done this year is the first review of the audit results, which will be at the next meeting in November. We'll have some preliminary, very preliminary, not final. They definitely will be cleaned up and changed, but a preliminary look at the results of the audit in November. And then the discussion on the key performance indicators that has been sort of ongoing and still working on that as well. So any comments on this, anything that I missed?
I have a question. So when I look at the 2025 work plan, it seems to be based on calendar year, whereas the 25-26 is based on October through September time.
Yes, I think what I'm gonna do is try to make it so that it is calendar year. In the past, the joint meetings were held a little earlier, and so the work plans did cover sort of the not really a fiscal year, but more along the lines of the fiscal year, and now the joint meetings are being scheduled at the beginning of the year. The work plans are now becoming for a calendar year. And so I was able to do that with this current year's work plan. Still need to do some cleaning up for the next year, because you're right, it does say, that it is, 25-26, and so, if I can before the next meeting, I'll have it cleaned up so that it is based on the calendar year rather than the sort of stretched across the two.
And then another question is, if I look at the 25-26 work plan, items number 7 and number 8, reviewing financial policies and investment policy, is there a driver why they have to be in those dates as they are currently scheduled for?
So the financial policies is because it's typically been tied to the budget. And so if there are changes to the financial policies, we've taken those to the council as part of the budget package. If the commission would like to separate the two, I think we can. I don't think that there's anything that says that it has to happen as part of the budget. I think it just is supposed to happen on an annual basis. And then the investment policy, I'm guessing that's just when somebody did it years ago, and so it's just kind of always stuck there. But again, I think if the commission wants to do it at a different time frame, we certainly can do that as well.
So the frequency, it says annually, but is there any requirement that it has to be at least once every 12 months? Or if we stretch it in one instance to say 15 months or something, is that a problem?
I don't think that would be it. If we wanted to move it to later in the year, and so it was 15 to 18 months between reviews, I think that would be okay.
Where I'm going with this is, as we have discussed before, our calendar tends to be more front loaded. And we have, lesser items that are part of the year. Anything that has some flexibility, it might be worth moving them to later part of the year.
Sure.
So
Yeah.
sounds like investment policy might be one of those things.
Sure. Well, and we could say that because they just set up the new investment strategy, and so maybe a year from now is when we want to review not only the policy, but also the strategy and whatnot. I could see that making sense. Okay, if that's the desire of the commission.
So the review of investment performance
Mhm.
that ended for September, do we consider it not done today together with the June performance or?
No, we don't have the report through the end of June, because I didn't want to pressure them to turn it around within a week of the close of the month. So we haven't gotten that one yet. So we'll have that at our next meeting.
Then it's not completed yet.
Year, yeah. Yes. Yeah. So this one's still pending.
John, the last two items, so the ad hoc items.
Mhm.
Is number 11, do we ever do that, or is it just, what triggers getting some KPIs out?
So that's something that the commission established a subcommittee earlier this year. These Chair Ottos and Commissioner Jane were on it, and came up with some ideas and whatnot. I think we're still working on some of those, and
Yeah, we came up with some recommendations for KPIs for the city, so we have a standard way to be able to look at our finances.
Yeah.
And as well as providing a lot of transparency around the finances,
Yeah.
so having
How do we
a
get- How do
platform,
we get a minute?
that's what we.
Yeah. And part of the reason for the pause was the city implemented our new financial software starting July 1. So the commission had talked and said, okay, this is what we want. And then we said, well, we're gonna get the new software up and running and then see what its capabilities are and make sure that we can have the transparency and what else we need to do to make sure we have those. So it's probably something that we need to have a conversation.
Maybe, should we add that to the next agenda item also?
Sure.
How does the new financial system go?
Yeah, we probably should add that to the next agenda too. We're busy agenda next time.
Yeah, I mean, so from staff's perspective, the new software system is going great. There's been some minor hiccups that we just need to work through or have had to work through. But I think those are becoming far less frequent and it's so much better than what we had previously. Okay.
Okay,
Anything else for next year? And the next year's work plan will be on the agenda for November, so if we need to add anything, we can do it at that time as well, so.
What is the commissioners' reports agenda item?
So this one is a standard item for all of our commissions. If you have reports, I will say our commission typically does not. So some of the other commissions, they get sent to trainings or they get sent to state conferences, like the Parks and Rec Commission goes to the Parks and Rec Conference. And so it's an opportunity for commissioners to come back and report and say that.
there's no financial commission meetings.
If you want to go to the CFOA conference, I'm sure we can get you there. Anyway, so this is typically, I mean, it's a standard that's on all of the commissions, but usually it's not relevant to the financial commission.
Okay, so the next item then is potential future agenda items. We've put down 3, I think. For next week, next time. Is that right, John?
Yes. Yeah.
Any other potential items? Okay. Your motion for adjournment?
Second.
You can just adjourn yourself. You don't-
Oh. We had to-
Yeah.
This commission is adjourned.
Great.
Thank you.